I traditionally don't like to make videos about the same company back to back a week apart from each other, but I think this situation warrants another video because there's been a huge update. If we hop over to M1 Finance here and we type in ticker symbol CVNA for Carvana stock, you can see that just in the last week, this company is down 51%. And this is off the back of me posting this video. Right around the time I posted this video, this was like the day before their earnings. And this video has about 1,000 views, which for me is above average. That's a great video. But what's really important here is to show how I talked about the warnings beforehand, no matter what the revenue numbers come out as, no matter what the profitability comes out as, I think that this company would tank. Go back and watch that video if you don't believe me, but I talked about the unit economics, and the overall business strategy is not one that I'm confident in. So I don't think it matters what this company is priced at. I don't think it matters what the revenue numbers come in as. This is a flawed business model that will not thrive in the future, in my opinion. I want to talk in this video less about the quantitative. I don't want to talk so much about numbers. I want to talk about business models in general. And I want to compare it to many other boom stocks that highlighted during the pandemic, that boomed during 2020, as you can see from this big revenue growth that really took place in early to mid 2020 and sustained throughout 2022. However, margins have faltered, free cash flow has fallen through the floor, and then as you can guess, the stock price on a 1-year basis is now down 97%. So you might be looking at the stock. You may be saying, okay, Carvana was $300. Today it's at $7. Now's the time to buy. I'm not so sure. We're going to talk about this in this video, and even if this company goes down further, if this company goes down to $5, $4, $3, if it even goes to 50 cents, okay, maybe at 50 cents I'd buy it, 50 cents or $1, maybe something crazy like that. But honestly, even at $7, this company, in my opinion, is still overvalued for the long term. Short term, the stock price could go anywhere, but in the long term, I think that this company is eventually destined to go to zero. I hope I'm wrong. I hope everything I'm saying is false, but I'm going to give my explanation in this video why. In the last video, I talked about this company only being able to reach a profitable, successful business model by reaching scale, and that stays true, and I want to discuss that in this video, as well as some other fun facts that I didn't get to share in last week's episode. So stay tuned. It's going to be a fun one. We're going to go over all different things, including shares outstanding, the balance sheet, which in my opinion has just gotten more and more awful by the quarter. It's not good. It's not good at all, and I don't think that it's going to be getting better anytime soon. But other than that, stay tuned. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I run my channel a little bit different. I show my portfolio balance at the beginning of every video at $34,500 as of now, my performance since joining this brokerage, my balance since starting YouTube, my portfolio holdings, my performance tab, my monthly YouTube income, my lifetime YouTube income, and my portfolio down below. So if you want to check that out, that's down below in the description, including mentoring opportunities, $10 for getting signed up for M1 Finance. So if you want to see this brokerage or you want to buy stock, hopefully not Carvana, you can get $10 for getting signed up, and you'd help support me in the channel like 132 people have done so far. So thank you for tuning in, and without further ado, let's go ahead and get started with Carvana, and let's just look at the overall general charts. You can see that the company did have pretty much flat revenue growth, down negative 2.7%. The free cash flow actually improved. They barely lost money, which is actually good. Only $200 million losses, which while that may sound crazy for Carvana, that's actually good. And I could sit here and I want to give bullet points, and rather than go through these line by line, because I really did that in the last video, I'm really just going to allow you to pause over these slides. This is all the numbers that the company just came out with. And what I want you to look at as we go through this is the economics behind this business. Not the revenue growth, not the expansion into other markets, the actual profitability, the actual opportunities to create margin from this business. As you can see, generally speaking, the peak that happened in 2021 for many of these vehicles for this business is finally starting to hit a reversion. As you can see in 2021, the gross profit per unit hit a max $4,500. Today, we've been at $3,000 or less throughout all 3 quarters of 2022. I'm going to talk about why I don't think that'll get better, and I don't think that the company will really reach margin that it's hoping for, and it will never have the opportunity to reach scale. Speaking of scale, that's the one thing that this company has potentially in the future going for it. The one way that this company really becomes profitable is by reaching scale. A company that is large, that is heavy duty, one that takes a lot of capital to build out is Carvana. It takes billions and billions. Let me rephrase that. tens of billions and tens of billions of dollars to reach a scale that is large enough for Carvana to reach a massive profit. They have some inspection centers, they have some car vending machines spread out throughout the coast on the east side, but really this company still has a huge part of the country with no international impact whatsoever, and they haven't reached a scale yet that in my opinion is worth mentioning. This company's market cap as of today is only about $1.5 billion, and as an example, that's literally only about 0.5% of the size of a company like Home Depot. And the reason I bring that up is because Home Depot is a company that obviously sells huge bulk items that has reached massive scale due to its long-term maturity, and I don't think that that one's going anywhere anytime soon. However, Carvana, this leads me to the next stage that I want to talk about and the importance of profitability. There's a couple companies I want to talk about here. The first one, I want to give two examples for companies that boomed in 2020. The first one, I want to look at Teladoc. Teladoc is one that has faced huge downturns in 2022, and honestly, even in 2021. You can see that if you look over the last 5 years, this company's all-time high was around $300. Now, it's okay that the companies went down in share price. All these companies went down in share price, and it is down a historic 80-90% from its all-time highs, and it doesn't seem to be recovering anytime soon. From that previous all-time high at around $300, today we sit at 27. Just in the last 6 months, we're down 18%. Year to date down 69, and the last year down 82. What has been important for Teladoc and what has been the one thing that has been taking this company down? Its lack of margin. If you look at this company, you can see that the free cash flow has either always been negative or very, very marginal in the positive. So small that it's almost irrelevant. If you look at this on an annual chart, this really becomes apparent. The only 2 years that it produced a profit, there was a teeny, tiny, microscopic profit, basically zero in 2019. And then last year in 2021, they put up an okay profit. You might be looking at $130 million and saying, wow, that's great. But considering this is a multi-billion, $4 billion company, $130 million is pretty negligible. Considering the last year they lost almost that much as well is almost not that great when you also see how bad these margins have gotten, especially in 2022. The moment that they hit a hiccup, these margins are evaporated. You see the first quarter was a huge loss. The second quarter was a tiny little gain. The third quarter was basically break even. Throughout the year of 2022, the first 9 months of the year, they're basically running at break even, and this is when this company is supposed to be thriving off of the big boom that it had in 2020. You notice the same thing that we show for Carvana. If you look at the balance sheet, one of the most important financial health statements of a company, if you look at its cash as of the most recent quarter was $900 million, and its most recent debt was $1.5 billion. Now that's okay, that's not too unhealthy, that's a pretty good balance sheet. The problem is that when you look at these side by side and you look at the overall trend, you see cash, ever since that big raise in 2020, is generally trending down or even staying flat. You look at the debt piles, however, and it is going higher and higher and higher, and it doesn't seem to be stopping anytime soon. This, in my opinion, is a company that is a bad company, one that will not thrive well past the 2020 booms that we had. When will this company ever produce a profit if it couldn't do it in 2020? I don't think it ever will. However, there are caveats to this. There are companies that did do well in 2020 and will continue to do well, in my opinion, throughout 2022. Notice, however, this is a company, Zoom, one that did have big booms in profitability in 2020, but was already slightly profitable before that and has maintained their margins, for the most part, throughout 2022. This is a company that produces billions in profit. Last year, in 2022, they produced $1.45 billion in profit, and they've been profitable with positive free cash flow every year since they went public in 2017. This company has been going in the right direction. It has sustained its massive boom from 2020 and held those profitabilities into future free cash flows to grow its business and widen its moat. Carvana, in my opinion, has not done that. Because the issue, when you invest in companies that don't make money, they have zero value creation. They only destroy shareholder value and ruin your potential for opportunities moving forward. Look at the shares outstanding over the last year. Just in the last year, it went from 65 million shares outstanding to 177. Your ownership of this company would have been split to like 40% of what it was a year ago. This company is giving out more and more shares, awarding its big executives, awarding its employees for working at the company, so you own a smaller and smaller percentage. And look at the dilution that this company is doing over a quarter basis. Now 105 million. That is 25% share dilution in a year. That's one of the worst share dilution I've ever seen. And I've seen a lot of stocks. I think 25% in a year, unless there was some big acquisition, which there wasn't. That is awful dilution, record high dilution, and the balance sheet is the ugliest part of all of this. Look at the cash in the most recent quarter. That big raise that they just did where they had $1 billion they raised. Well, yeah, there goes 700 million of it. Now they're down to 300 million. And what about the debt pile? Has the debt pile improved at all? Nope. It's gotten bigger and bigger and bigger. And so when you invest in companies that are not profitable, you are setting yourself up for failure. When you invest in companies that are profitable, the entire game is rigged in your favor. Companies like Microsoft that year in, year out, grow their free cash flow for the long term generally have upward trending stock prices. Look at the last 5 years for a company like Microsoft. It's not by random chance. It's not because investors got excited and bought this company up. Well, sure, they maybe got a little excited. The general trend is this company is growing profits. Now in 2022, with some margin decreases, you see that the company's going down. It should get punished as it goes down from its profitability, but generally speaking, this company is holding up well, still producing tens of billions of dollars, 17 billion in profit in the most recent quarter, but a company like Carvana, I don't think will ever do that. And then last but not least, to close out this video, I have one closing remark. There's all these different companies that you can invest in the market. There's tech companies, there's oil companies, there's foreign stocks, there's vehicle companies, electric vehicle ones like Tesla, e-commerce businesses, healthcare companies. There's so many different places to put your money. It's crazy. And out of all the companies that you could imagine, all the companies that you could possibly put your money into, why Carvana? If you're putting your money in Carvana, just be honest with yourself. The reason you would buy this stock is for a complete gamble. You see it go from $360 and you see it today trading at 7 and you say, ooh, maybe it could shoot back up to 15. Maybe it could shoot back up to 20 or 30 and I could quickly 2, 3, 4x my money. But the honest to God truth is, I don't think that's ever going to happen. This revenue growth, in my opinion, will stagnate. The profitability will continue to stay negative. They will continue to dilute shareholders, and overall, the shareholder value will continue to go down. They produced one time. Keep in mind here, one time in 2021, there was a single quarter they produced return on capital employed in the positive, which means for every dollar they put into this business, it produces negative returns. Let me break that down for you. Let me make this super simple. In the most recent quarter, it was negative 4%. So let's say I hand Carvana $100 and I say, buy something for your business, invest in your business. That $100 I hand them, a quarter later, they'll hand me back $96. They will have burned 4% of it. And that has been the case every single quarter for this company being a public company. Other than that one hiccup in 2020, they produced a positive number. But other than that, 2020, 2021, 2022, this company fails. This company fails to produce margin. And for that reason, I'm out. Thank you guys so much for watching. I appreciate you watching all the way to the end. Check out all the stuff down below in the description if you haven't already. But without further ado, my name is Jordan. I'm a millennial investor, and I'll catch you guys next time.